Good morning. Welcome to the IE Investment Management Macroeconomic and Market Update. Today, I'm discussing with Sébastien McMahon about macro and asset classes outlook. My name is Rose Marcello, and I'm a Director, Client Portfolio Manager. Sébastien is Vice President, Asset Allocation and Chief Strategist, Chief Economist, and Portfolio Manager. Sébastien, thank you for being here.
A pleasure, Rose.
So let's start maybe with markets, some divergences that we've seen between Canada and the US in September. How do we explain that? We see it both in bond yields and economic indicators. And what conclusions should we draw for the short and medium term?
Sure. So maybe I'll start with the economic part. Last time that we spoke, we were focusing on the US economy, which had 2 consecutive quarters of negative growth, which used to be a definition of a recession, but now it takes more than that. So there's a committee that analyzes all of the data and decides when there's a recession or not, and we're not there yet according to that committee. But we are looking at Q3 now, which is getting more and more likely to be negative too. So that would be 3 consecutive negative quarters. But on the flip side, in the US, even though GDP is under pressure, the labor market is still going strong, still creating jobs. The housing market is starting to sputter, but not at an alarming pace yet. So the US economy is in a different situation than Canada, because here we have positive GDP growth still, because we're helped by the exterior sector, the trade sector, but our labor market is slowing down. We've had a few consecutive months of negative prints on the jobs reports. We did recover all of the jobs that were lost during COVID much earlier than in the US. So probably we're just earlier in the cycle of accumulating jobs and then seeing some job losses. The housing sector in Canada is also slowing down right now. The Canadian economy being much more sensitive than the US to interest rates, we're starting to see an impact on housing, but also on inflation. So the inflation figures are slowing down here, not yet the case in the US when you look at the core inflation, the sticky components of inflation. So, I mean, many commonalities, but we're not exactly at the same place in the cycle. But looking forward, late 2022 and into 2023, we are still expecting a recession on both sides of the border, a recession that might not come with massive unemployment spike. The bar is pretty high for massive layoffs, but still both are going in that direction. Looking at markets now, we also discussed last quarter that we were in a bear market, and the playbook for the bear market continues to unfold pretty much as according to history. We had a bear market rally that was vigorous during the summer. It faded, and the bottoms for bear markets, the ultimate bottoms, tend to coincide with either the bottom in economic data, so roughly a 2023 story, or a real pivot by central banks when we start to hear from them that they're worried about the economy. Not just that they're taking a pause from hiking, but they have some real worries, probably again, a 2023 story. So very interesting juncture we find ourselves in right now.
Indeed. Another concern on markets is the US dollar. So it's being very strong, reaching heights we haven't seen in 20 years. And this negatively impacts both main trading partners at the US, but also US large corporations was revenue for a large part is earned abroad. Where do you think the valuation of the dollar stands? Is the top near?
Yeah, sure. Is the top near? It's always a tricky question. Likely, the top could also be a 2023 story. Of course, this is just a forecast. It's hard to tell right now, but typically, the peak in the US dollar tends to coincide with the bottom in global economic activity. So we are still hearing about COVID-0 in China and difficulties in the Chinese economy. We're hearing about the energy crisis in Europe, and it could be a tough winter ahead. So bottoming in the global economic prospects, and then probably some verve coming back to the global economic cycle. Likely that's a 2023 story. Until then, the US dollar is expensive right now. It is a safe haven when there's risks in the market. When risk sentiment is low, money tends to flow towards the USD. This is contributing to bringing more risk sentiment to the market. So this is self-feeding. The bottom, the peak, I don't know exactly where it's going to be. Likely, we still have some months ahead before we start to see a definitive turn. But I'll tell you that when we start to see the US dollar turning and getting lower, it's going to be a very interesting opportunity to start hedging or exposure to foreign currencies in portfolios.
Speaking of exposure and considering what we've mentioned earlier, where's your positioning right now?
And positioning, there's two columns here in the table that you see. On the right is the 12-month forward view. So there's a lot of green because when the market is already down 25%, like right now, and when rates are at the highest level since pre-financial crisis of 2008, well, it pays to invest if you can take the volatility over the next few months. 12, 24, 36 months ahead, really you'll be in the green and you'll be happy to have invested now in stocks. Same thing for bonds. So prospects for long term are interesting, but in the short run, we're active managers, tactical managers. That's our job to navigate that. So we remain underweight equities. We see indiscriminate buying and selling depending on the weeks. So that's why we're underweight equally in all regions. We have cash on hand, so our money market holdings is higher than normal, and we have more bonds, more duration than normal because we do see volatility ahead. So it's good to hold bonds, and we see attractive rates.
Well, thank you so much, Sébastien, for taking the time today.
Always a pleasure.